Good evening, everyone. The last session of the series, we have a very eminent speaker, Shilpa Rout madam with us. To give a brief introduction about her, she is a research analyst at Prabhudas Lilladher for the past 3 years. She is an MBA by education. She has worked extensively in this field and is currently heading the derivatives desk. Her contribution in the industry has brought her immense competence and also won her the Best in the Category award at Prabhudas Lilladher last year. She would be guiding us on understanding the strategies on derivatives and options for today. So over to you, ma'am. We are keen to listen to you.
Okay, hi. Thank you, Meera. Thank you for the wonderful introduction. I hope I'm audible to everyone. Is it? If yes, can you just just ping me something so that I can know I'm audible enough?
Yes, you're audible. Perfect.
I was just, going through Anjali's session in the past few minutes, and I could see that she's beautifully covered, all the basics that are required for derivatives, like, understanding what is derivative market to be precise, and, few terms that, on daily basis that every person, participating in the stock market, they come to hear when they are doing derivatives. So I'm glad that she's given you all a good brief. And from here on, I would just try to sum up the few important key terms that is important while understanding derivatives. And going ahead, my session would include a few indicators that we follow on daily basis in derivatives and few strategies. Like I've been hearing a lot of people asking about hedging and all and how to do it. So I will try to make the session very simple and even for a layman to understand how to get along and start. So not wasting any more time. So let's start. So like everybody is aware that I had the derivative desk at Prabhudas Lilladher. I've been associated with this organization for the past 3 years. And whatever I have learned and whatever I have been doing, I'll be sharing with you today. And if any sort of query you have, we'll definitely have the question and answer round followed by the section. So let's start. So this is something that Anjali has already covered. So I'm not getting deep into it. It's just what is derivatives and what are futures, options. And we all have already understood that these are standardized contracts. But the key important factor one need to understand is that why do we use derivative? If there's equity cash, then why derivatives? Derivative is a platform that will provide you hedging against price fluctuations. That is one what would we say, a concern for any person entering this stock market. How do we first protect our principal amount that we are investing? So derivative helps you with that. We have lots of liquidity, we have leverage facilities when we are doing derivatives. Transaction cost is quite low, and so what is this leverage we are talking about? One need to understand what is the difference between this cash market and derivatives market. If Anjali has already covered, but I'll just make a quick brief about it. See, when you're dealing with cash market, you need 100% investment with you. Let's say you want to buy Reliance shares. So whatever, and you have an investment of 1 lakh. So you can buy a Reliance share only with the investment that you carry. Let's say 1 lakh only, whatever share it comes around, you can buy that. But in derivatives, it's not that. You have a leverage here. You just require 20% of that investment, let's say 20,000 to 30,000 only to participate in that market. And you can trade in Reliance contracts. Like we already know, in cash, we don't have one job. I mean, in cash, we can buy any number of shares. It can be 1 share, it can be 2 shares. But in derivatives, it's always about lots. So like we are giving an example of Reliance. So Reliance, it comes around 250 shares now. So that is what we do. It has to be lot wise. You cannot have a single share in derivatives. You have to play in lots. And in cash, you have to take delivery. But in derivatives, there's nothing like delivery. We either participate in index futures, index options, or stock options. And in cash, the main thing is that the benefit is that you have the ownership of that investment with you till you don't square off the positions. But in derivatives, it's not like that. We have the contracts, so it's every last Thursday of the month. You either have to square off before that, or it will automatically get squared off. Of course, there are some conditions to it, like we can have the rollovers and all, which we'll see in the further slides. So this is the brief and very quick difference between cash and derivatives. People who want to understand why do they have to do derivatives. This is something which Anjali was talking to you about. What is options? We are all aware of what are option trading. There are two options, participation. Either you buy a call or you buy a put. Call means when you are bullish, put means when you are bearish. So but the difference between an option buyer and option seller is one thing one need to understand when you are doing derivatives. When you are an option buyer, your risk is very limited and profit is unlimited, because you pay a price, you pay a premium that comes with option. And option is even a more leveraged product than the futures contract, because in comparison to cash, if you require 20% to deal with future contracts, in options you require more, even 20% of that 20% of the future contracts, because premiums are way lower that you have, and you can participate in that market completely. Let's say you are doing let's say nifty, if you want to participate, you have now weekly contracts, you have monthly contracts, so you have the option of participating in nifty in various ways. You can do cash, you can do futures, you can do options also you can do weekly, you can do monthly. Weekly it is even more cheaper than the options for the monthly contracts. So option buying is always preferable for people who want to play safe, because you know what is your loss, because whatever you're paying for the premium is the max you are losing. So that is how it is. But option seller, it's the other way around. You have limited profit and unlimited risk, because that premium that is supposed to you were supposed to pay, you receive that as a credit to yourself, and that is the maximum profit you can earn. And you would expect that it becomes zero nearing to expiry, so that you have all the premium with you. But it is unlimited risk, because if the view goes the other way, let's say if you are bullish and you have sold let's say put, and you are sitting there feeling that nifty will go up, I mean higher from here. Let's say there's a correction, then what happens, that put premium will increase. So let's say if you have received a premium of 100 rupees and nifty goes down, that premium might be 105, 110, 200, whatever. And what is the difference? It is that you have to pay it out of your own pocket, in a very simple layman language. So selling option is very attractive. There are many ways, we hedge, and we have many strategies based on selling contracts. But it has to be done with, proper guidance, and everybody has to understand how to take that risk and where to cut it off. So option buying and option selling, this is one key difference. So like I said, option price is what we just need to understand. It is the price which the option buyer pays to the option seller. And strike price, like we have already seen, we already know, the option chain, there are many strike price. That's a nifty trading at 15,000 today. We have strikes of 15,100, 200, 300, then also 14,900, 14,800, 14,700. So likewise, we have, very strikes for every contract. So that is the strike price. So when the view is bullish, we buy a call option or we sell a put option, like I was just discussing. And when the view is bearish, we sell a call option or we buy a put option. This is how option plays. These are very basic things that we do in options while participating. So this is something I guess everybody must have gone through. Let's say, like I was saying, let's say if you are bullish, there's a stock, let's say ABC, and you are buying a 500 strike trading at maybe 502, 503. So you want to participate. So what do? You buy a 500 call strike, maybe trading at 4. So your CMP is likewise. So this is how you just participate while doing in participating in market. So this is what like if somebody is not keen on doing cash and futures also, that person is not keen, you have the benefit and thing that you can participate in options, even paying even lower margin. So these are few terminologies that we use in options trading. Intrinsic value, it's the difference between the strike price and the spot price. Spot price is cash and strike price are the strike values we have. And in options, one has to understand and one has to remember this time value factor. This is the theta. There are Greeks of options, we know many, all of you must have heard also. But of all the Greeks, for me, time value, the theta factor is one key important factor when you are doing options, because everything depends on this time value, theta factor. So what is it? It is a time to expiry of the contract. As the expiry date nears, the option premium decays. So this is what is the loophole when you're doing options. So when you're participating in options, we need to understand that uh, uh, we have to only enter options when we have a very concrete view and it has to be quick. Let's say I'm bullish on HDFC Bank today, and I don't want to participate HDFC Bank in futures because it can be a gap up, gap down thing, and tomorrow morning, and I'm not sure how will it happen. But I think it will go up. So what I can do it, I can buy a 1500 50 call or 1600 call option because I'm bullish. And in that matter, what happens, I'm expecting that tomorrow or day after, in a couple of sessions, it will zoom up to 100 points. So in that ways, what we do, we enter options because it is safe. We know in a couple of days we'll have our target done. So not taking a risk of losing too much of capital, we enter the option, and in a couple of days, if our view sets right, we gain a lot. But if in case the views goes the other way around, or it doesn't play for a week or so, so as we near to the expiry, let's say 2 weeks from now for February contracts. So if I'm entering HDFC Bank on long contract today in options, and it doesn't play off in a maybe by Monday, Tuesday, Wednesday, what will happen that the price that, let's say HDFC is trading at 1550 today, and I have bought a call option of 1600, let's say for 30 rupees, let's say. What will happen if HDFC Bank tomorrow opens above 1550, 1570, 1580 or 1600, then I'll gain massively with options. It is as good as futures to me. But let's say it doesn't go, and it opens 1520, 1530, and throughout the day it passes around 1500 to 1550. Then what will happen, Saturday, Sunday, after when we open on Monday, we will have a time erosion, time contract erosion because of time value for 2 days. So what will happen, even if on Monday, let's say HDFC Banks open at 1550, our option value won't be 30 anymore, 1600 call option. It would be definitely 22 or 23 because we have some erosion during the weekend. And if on Monday it doesn't move up immediately, and it keeps on lingering around that same strike, same price, our option value starts decaying massively. So this is how option is very tricky. So whenever you are entering an option contract or option trade, you have to have your view very strong, very straight, and it has to happen quick, or else you will start losing out money. So this is how, if you are an option buyer, this is your demerit. Likewise, if you were an option seller in this scenario, it would be helpful to you. Let's say the same thing, I have sold 1600 put, let's say, and Nifty, I mean, HDFC Bank is neither coming down or it is not going up, it is going nowhere. Then also I will benefit from my put option because it will start eroding. Let's say I sold put option of 30 rupees, And 500 into 30, I got 15,000 rupees for myself to my credit with HDFC Bank. And Monday it is opening at 20, so I'm already gaining 10 rupees there, so I'm already gaining 5,000 rupees there. And if HDFC Bank goes down below 1500 or something, then it is very good, it's a jackpot for me, because that put option would would increase, and it will start eroding. And in that case, what will happen, I would actually have the value of the net that I have credit I have got. So this is how, when you're selling option, the time value becomes your friend. If you're buying option, the time value becomes your enemy. So in simple language, this is how we need to understand. So, and few more terminologies that we come across on daily basis. आप सुनते रहते हो, this ITM, OTM, and ATM. So ITM is what? ITM is nothing but it is in the in the money option. Like like I was telling about, let's say Nifty trading at 15,100 today. So any strikes below 15,100 in call side is my ITM, and it is the opposite on the put side. When you open the option chain, and after going to NSE side, you would see the left hand side to be call side and the right hand side to be the put side. So and it is always the opposite. In the money for call would be our OTM, out of the money for put. So it is likewise opposite. So any contracts below 15,100 in strike, in this option page. Do you guys want me to open the NSE side and let you know, show you how to see the call side and the put side in option chain, or is everybody aware of it, so that I can, likewise explain? Okay. So when you go to the NSE site, NSE.com, this is the page that comes up. So you can select any contract here. Let's say I'm selecting Nifty here. So this is how it comes. So I would go to option chain here. Just a sec. So I would go to option chain here. See, this is how it is. The option chain appears. These are the call side and these are the put side. The area that are marked in yellow are the ITM, and the area that are marked in white are the OTM, that is out of the money. So you can see call options, ITM, and put option, OTM, ITM, they are opposites. We are trading at 15,100, so this is the best place I can explain you. So call option, any contract below 15,150 are ITM for Nifty, and it is the opposite for put side. Above 15,150, all the contracts are ITM. And likewise OTM, these are the OTM, that is out of the money. These are the out of the money. And ATM is what? At the money. At the money meaning Nifty trading at 15,150 around would be our ATM. So these are also key terms that we use on daily basis, because whenever you enter an option, we are always asked to choose, whether we want to go to into the in the money contracts, or in strikes, or out of the money strikes. So for safe traders and people who are very conservative with their views, and and also with their investment, they can always choose OTMs. OTMs, what happens, OTMs are little cheaper than in the money contracts, because once you choose in the money contracts, it is as good as futures. So you only choose in the money contracts when your view is very, very bullish. If you're bullish, you can choose. If you know that tomorrow morning Nifty will open above 15,200, then you can go for 15,100, 15,000 strikes, contract as well. But if you're not sure, then better if you can choose 15,400 or 500. Likewise, if you are sure that tomorrow morning Nifty is going to open below 14,900, then you can always go for puts that are, in the money, 15,300, 400. So this is how the option chain is seen and understood. I hope this is clear, because this is very important once you need to understand options. Okay, now we'll go back to our presentation. I'll just share the screen. So this is back to our PPT. So this is how, okay. Now these, whatever I was telling you, Anjali has already covered. I was just giving you a more detailed, ways of seeing things for any layman who's understanding derivatives. See, now it is a different leap that we are going to take. Somebody who wants to do derivatives, few indicators that are very important on daily basis to know while you are doing derivatives. Okay, somebody is asking what is the meaning of LTP? That's the last traded price. Okay, just questions and answer. We can do it later on after the session. For now, let's understand, because this is very, very important. See, derivatives, like I've said, we have leverage, we have hedging options, but the main important factor to choose derivatives is because we have rich loads of data with us, indicators with us to understand why and when to enter the market, when to enter your particular stock, when to enter, when to exit. Derivatives gives you a very crisp view, and it can and the success ratio while understanding the derivatives and dealing with the market is very high. So what are these? See, one thing everybody must have understood, OI. We have repeatedly hearing this OI, OI, OI. So what is OI? OI is nothing but open interest. Open interest, as the name suggests, it is nothing but the number of contracts that are currently held live in the market, that are active. And it is actually the interest of the traders that is lying in the market. It is very, very, similar to its name, open interest. The contracts that are still active, open, and you can, why do we use this indicator? Because it shows the interest of the market in your particular trade. If you are trading with, let's say, Nifty, and you want to know, how is the view of all the participants in the market, so OI helps you with that. OI lets you know where is the interest of the people who are dealing with Nifty for that particular day, or let's say for that particular moment, whether it is bearish or whether it is bullish or whether it is sideways. So open interest is very important. Open interest is always clubbed with volume to understand, because it's only interest doesn't matter. There may be 100 people in the market for Nifty today, but if you don't know that how many people are for the bearish side and how many people are the bullish side, you won't help. So volume makes it possible. So it is always clubbed with volume, and there are very key thumb rules when you are understanding open interest. So we'll see that how to interpret it. Like I've said, OI identifies the number of contracts that are currently held. OI denotes the number of active contracts. OI can increase and decrease. The key difference between volume and OI is that one seller and one buyer together, they are one open interest, but in volume it would be two contracts. Volume can only increase, it can never decrease, because let's say I have 4 buyers and 5 sellers, then as a whole volume for me is 9, but for open interest it would be only 4, because there is one the one seller, laying the flat to have someone on the buying side to come. So that is how it is. OI for one buyer and one seller together, they make it as one open interest. That is why it is very important, because it shows you the liquidity also. If you are a buyer, and there has to be one seller also with you to have this open interest. So, a very high OI in a bull market is a worrisome signal, because, let's say you 9:15 in the morning, you enter and you say that you want to trade in, let's say, Kotak Bank, and you see OI is 33%, 40% in the morning, and you get very excited saying that, oh God, 40% people are very much interested. But you don't understand the price action with open interest. Let's say, oh, Kotak Bank has, opened very strong 1950, 2000 today, and you think OI is very high. So, it is very, very safe. We can go for the upside. But what happens? Suddenly you don't know whether the people bought the contract the previous day and they would just immediately go for profit booking. And, suddenly what will happen? The price falls and it goes into the negative territory. So very high OI in a bull market is a very worrisome signal. So one has to understand to stay away from very high OI in the early morning of the market. Sorry. So this is the thumb rule that we follow with OI. OI, when it is positive, and price is also rising or it is positive. It is very important. Please understand, it has to be rising or positive both. What action do we have to take and what does it indicate? It is a long build up. I mean, the outlook is bullish. When, remember, when OI is positive, high, price is also rising and it is positive, the action is long built up, and that means that we have to go long with that particular trade. When OI is positive, price is falling and negative, then it is short built up. That means the view is bearish. So remember, when OI is positive, high, but the price is falling, that means that we have to sell that particular trade. When OI is negative, shedding, or let's say it's coming down gradually, and but the price is positive, that means the short covering. Short covering is always sideways or mildly bullish. So very many people, use short covering as a very key indicator to trade in the market. Whenever they see there's short covering happening, they, buy that particular stock for a quick trade, but not very long bullish trade or something, but for a quick trade and quick profits, and they exit immediately. And OI, when it is shedding or negative and price is also falling and it is negative, it means that it is long unwinding. And that means, stock or that particular contract, script is nearing its climax. It could either go down more rigorously or it can go up from here. It's completely at some, climax there. You don't know how the stock is going to be. So in that case, we have to wait and watch. So this is OI, how to understand. And there's another indicator, that is rollovers. Rollovers are very important at the start of the new series for the first week, particularly. Like rollovers, many people were asking in the last session. I was just hearing, what are rollovers actually? It is very important when you are entering a new series in derivatives. Let's say from Jan to Feb, when Jan series was over and Feb you are entering, first day, or let's say first couple of sessions, you are completely blank. You don't know how to read the market and which stock to pick for the month, and where to go long, where to go short. Their rollovers, they play a very key important indicator. So rollovers are what? Rollovers are, Jan series, like I was saying, contract. Let's say somebody was bullish on Reliance in Jan, but his target didn't come, so he wanted to roll over to the next series, let's say Feb series. So what happens? He roll over his positions. Of course, it carries certain cost with that. When you are dealing, your dealer will explain you what is the cost that you have to pay for that. So you enter into the similar trade into the next contract. So rollovers only happens in futures, it never with options. So this is one thing we need to understand. So rollover is what? It is just an indicator of traders' willingness to carry forward the bets on the market. So whatever bet I had for Jan series, if I'm not convinced, I'm not getting, but I know that it will happen sooner or later. So what I do, I carry my bet for the next series, or maybe the March series as well, because we know we have immediate contracts near month, then next month, then the farm month. We have 3 contracts. So this is one indicator that we have to understand. Whenever the rollover is above 85%, we see it as a very strong willingness or the strong interest. And whenever the rollover is below 40%, we see it's a very weak interest for that particular trade. So rollovers are very important when you are entering into a new series, and particularly for the first week mainly. It helps you to understand where you want to place your bet for the month. So like I was saying, roll cost you have to bear when you are doing into the next series. So this is how it is. Let's say the current price is 1500 and the next series price is 1550. So roll cost would be the difference between the two series price, that divided by the current price in a series into the percentage. So this is how it is calculated. This is how it comes up. But the main thing that we have to focus is here. So how do we understand the rollover series with a price? Higher rollover, positive price action, it suggests that the strength of the stock or the particular script would continue. That means it is bullish. But higher rollover and negative price action, it suggests that, it would be a bearish, particularly maybe a week or the month for that particular script. Then lower rollovers, positive price action suggests there's a pause in the uptrend. Like we have seen, rollovers are low, but price is positive. That means people are less interested. So maybe, you know, there won't be much volume or much participation initially. So maybe the uptrend that was continuing, that would halt. And lower rollover and negative price action means that, you know, that particular script is likely bottoming out, and, you know, then we have to wait how it is behaving to see. So rollover also plays an important indicator when you're doing derivatives. Another very important and key indicator that we keep hearing is put call ratio, that is the PCR. The put call ratio, it is a very popular tool designed, you know, to help investors gauge the overall sentiment of the market. It is again paired against both volumes and OI, but majorly with OI we do. So how are PCR calculated? PCR is what? It is the total traded put contracts divided by total traded call contracts. In the analysis side, like we have seen, the option chain, call side and put side. So that is how I'll just show you so that it is easy. Okay, is everybody seeing this? This is how it is. You know, let's say I want to know the PCR of Nifty of 15,200. PCR can be done overall also for Nifty. We can also have individual strikes PCR. And why do we have to have individual strikes PCR? I'll let you know. Let's say let's say I want to have the PCR of 15,200. So what would I do? The total number traded of put contracts. This is the total contracts on the put side, and these are the total contracts on the call side. So 15,000 to 15,200 PCR would be this 66,427 contracts divided by 68,991. So whatever it is a PCR. So why do we need PCR? PCR shows you the like, you know, PCR helps you mainly to understand the immediate resistance and the immediate support for the you know, for the trade. It works beautifully with indices, bank nifty, nifty, it works beautifully. So how do we understand PCR and how does it see? Whenever any strike, let's say if you let me repeat, PCR is very, very beautifully, you know, you can understand, and it helps a lot when you are only doing indices. It gives you a very concrete and a very sure levels to understand. Whenever the PCR, you know, for any particular strike is above 1.5, we see that as a very strong support. That means, let's say 15,000 PCR for today is 3. So, or 2 or 1.8, let's say, that means 15,000 will act as a very strong support on immediate basis. Let's say it's 1 o'clock in the afternoon and you are entering the market, even not there in the morning, and you wanted to enter, you know, nifty trades at that particular moment. So one quick indicator that one can see to understand what to do and where to do is PCR. If you can go and let's say nifty trading in 15,100, you can just check 15,000, 14,900, like with 15,200 and 15,300 strikes PCR, and you can understand where it is above 1.5. The more it is better. Like, let's say whether it's 2, 2.5, wherever you find that, that means that that is the major support nifty will have, and it will not break that very easily. So you can always either wait nifty to fall towards the support levels to buy, or you can trade with your strict stop loss. You know that this is my stop loss, I can safely play with this. Likewise, when the PCR is below 0.6, we see it's a very stiff resistance. So like we were seeing that 15,200 strike, it is way below 0.6. So for us, that is going to be a very strong resistance. So if Nifty is trading at, let's say, 15,170, 80, and you know that 15,200 is going to be my resistance. So nobody will enter the trade at that time. Either you will wait to 15,000 to 200, let it test around 190 or 210, 220, then you would sell, or you can wait for 15,000 to come so that, you know, it becomes your support, and you know that you will have a margin of 200 points to trade. So PCR on immediate basis, when you are doing indices and you are just entering any moment in the market and you want to have a trade, is a very quick and a very concrete indicator to trade. I hope this is something we understood. So likewise, these are very clear indicators. So the tricky indicators, it is movement sharply from 0.6 to 1. Let's say, like I was saying, let's say there's a 15,100 strike PCR is 0.65, you say, you just saw. Then, in half an hour when you are just watching the market, you see that, it's rising 0.85 or 0.9, or it is moving towards 1. That means that, market will, in a very quickly, it will run up for, let's say, 50, 70 points. So, you have a trade there also. You can enter the market and you can have your trade. Likewise, if if the PCR of that particular strike, some price is falling from 1.5 to, let's say, below 1, that means profit booking is going to happen and there would be some downside momentum. So these two levels are very critical, but if you keep monitoring and once you have a practice of this, you will always have a bigger picture and a bigger space to enter the trade, because you will already know how the movement is going to happen, so you have a margin of more profit making. So if you know that Nifty is going to fall now, and it is already trading at the higher side, at the resistance side with PCR. So let's say 15,180 it is trading, and you see that 15,200 is my resistance, and the PCR of 15,100 is also falling. That means it will come down aggressively. So I have a margin of more than 100 points. So I would do that. So this is how it is done. It is very, very important and very, very helpful indicator when you are doing particularly with indices. Stocks, it does help also, but with indices, it's beautifully done. Every day, any person can just have a hang of it, and you would have a very high success ratio while doing indices. Okay, somebody's asking where can we find PCR? So I just showed you, Kalpesh ji, that how do you calculate, and for the whole Nifty PCR, is you can have it in any software, any site. You can go, let's say MyFNO or Falcon, anything that you use, you can find overall PCR. Okay. So another indicator is VIX. VIX we have been hearing every now and then, because it is one of the very key indicator for everything. It's whether you're doing derivatives, or whether you're doing cash, whatever you are doing, if you're into the market, VIX you need to understand. VIX is what? It is a fear measurement, the fear of uncertainty. Let's say there's an event happening, elections are there, or budget is there, and you don't know how the market will behave. So VIX, captures that. VIX, if it's very high, that means that it is inversely proportional to market. If VIX is high, market falls. If VIX is low, market goes up, because the more the fear, market is very uncertain, the more volatility will come. And the lower the VIX, that means people are settled, people are sure of the sentiment, so volatility will be less. So VIX is nothing but the fear measurement of the market. And it is also like it is considered as a reflection of the market sentiment. मतलब market का क्या mood है, क्या sentiment है, VIX helps to understand. Then one must also understand VIX is a leading indicator. VIX tells you beforehand how the market is going to behave. If anybody watches VIX on daily basis, they can understand how the market is going to behave. So it is a very important leading indicator. It also gives you a heads up to know the sentiment of the market, and you can plan your trade accordingly. So how do VIX helps us in derivatives? VIX is very, very crucial when you're doing options, because when VIX is high, option premiums are very high. In that case, people who are very used to it, many sorts of strategies, or they're very into this, they sell options because premiums high, so they get more credit to their account, and if they know the direction and they know how to play it right, they make massive profits. So VIX is very, very important. So these are the parameters when you are doing VIX. So it is, like I said, indirectly proportionate to the index behavior. 11 to 14, when VIX is there, it is a very safe zone. That means there's nothing uncertain about the market. People are settled with the behavior. 14 to 18, it is speculative. When it trades between 14 to 18, you don't know whether it's going to go up or go down. So it is a very speculative zone. Then above 18, it is a negative zone. But for the past 1 year, since the COVID, VIX has been playing very differently. We have tested highs of 85. Now we are continuously trading between, above 18, continuously trading above 18. Now 23, 24 is where we are. But probably this is again a new normal range for VIX. And it's going to be like that for some time now. So 18, 19, when it comes, we get very nice, bullish trends happening. Even 20 to 24 is happening, and we're still very bullish. So for now, VIX, when it goes above 25, it would be a leading indicator for us to know that market is uncertain and market might have a correction. For now, since COVID. So how do VIX play can help us? So this is something I've come up with, which I follow. I club VIX and PCR together to understand and build up strategies and options. When PCR is positive, let's say between 1 to 1.6, like we know, because 1.6 and above, it is support. So it's positive PCR. So, and VIX is below 15, the previous normal, the new normal would be below 18, let's say. So our outlook would be long built up. That means we should be having bullish strategies. Bullish strategies will also cover all the strategies now. PCR, when it is negative, that is below 1, then and the VIX is rising, then it is bearish strategies that we have to go for all the option strategies that can help us with negative views. Likewise, when PCR is negative, VIX is rising, that is above 20, that means we are into the oversold zone. That means, people have sold a lot. We can see a cat bounce, what we say, like, mild pullback. So we can go for moderately bullish strategies. Likewise, when it is overbought zone, we can go for moderately bearish strategies. So these are the indicators that we just covered up: VIX, PCR, OI, and how to read these indicators. It takes a lot of practice, lot of understanding on daily basis. Whatever indicator you choose, please have a thorough practice. Try and do paper trading to understand how that particular indicator can help you enter your trades, and when to enter, when to exit. Indicator, these are all theories, but one has to practice to understand and have a grip over that. I hope till now indicators are well understood. If there's any query, you can ask me. I can help you out with indicators. Now then we can go forward for strategies. Okay, I guess everybody is quite settled. Okay, how to check volumes on NSE? So for every particular strike, if I go here, I'll show you. See, if this is the option chain and you are here, this is the total OI contracts. This column is the fresh contracts that are being added, and this is the volumes column. So this is how you also this side, total contracts, fresh OIs, and volume. This is how you can understand volume thing. Okay, and no more queries, so we'll proceed. Okay. Now going forward, we will be seeing strategies. Like we've understood, derivatives, it helps in hedging. We have some bullish strategies, we have some bearish strategies, we also have some very non-directional or sideways strategies. We'll just quickly cover a few and very simple ones that are practiced on everyday basis. So what are covered strategies? It's mainly done for hedging against underlying future holdings against ATM options. So let's say when I was hearing Anjali was explaining, someone was asking, let's say if you are long in futures, you have Nifty futures, long, but you are very uncertain, you don't know what will happen tomorrow morning. So what you can do is that if you have one lot of Nifty futures, you can do one thing. Let's say 15,100 you're long today, you can buy 15,100 put also at the money options to just minimize your risk. Let's say tomorrow if market comes down, your future would be in loss, of course, but your put would gain, which would minimize your loss. It's a limited risk trend following strategies. Buy futures and buy put options. Sell futures. If you're selling, then you buy call options, because it's the opposite. It will help you. Options, here when you're hedging, one need to understand what is hedging actually. Hedging is nothing but your insurance to the your investment. You just minimize your risk and you have some cushion. So option play here acts as an insurance to you. So this is an example. Let's say Nifty future is at 14,900. So what you do is, if you're buying Nifty futures at 14,900, you buy a 14,900 put at 100. So lot size of Nifty is 7,500. So your break even is 15,000 for 14,900 plus your put 100. And your maximum risk is what? You have bought a put at 100 rupees. So 7,500 is the maximum risk for the put that you have bought. And reward can be unlimited. So let's say two scenarios, market expectations tomorrow morning. Suppose you're bullish and Nifty goes to 15,200. So what would be a future gain? 300 rupees, 15,200 minus 14,900. And your option loss would be 100 because that's the maximum that you can lose. So let's say 300 minus 100. So you're still in profits of 200 points. That is 200 into 75, 15,000 to unlimited upside. As up Nifty goes, you would be adding up to your profits. But let's say Nifty goes down. It goes to 14,600. Your future loss would be 14,900 minus 14,600. Let's say minus 300 points. And your option profit would gain as well. You would be gaining the 200 points because 100 points, 100 rupees have already paid. So that is an investment. So your profit will be 200 rupees, but your future loss is 300. So in that regards, what will happen? You only lose the option. Here, your net loss is only the option that you have paid because your option also, as the Nifty declines, will give you profits. So this is how hedging helps. So let's say if you're bullish, so what sort of bullish strategies we have? What we do when you are a bullish sentiment you have? So we buy stock futures, or we buy call options, or we sell put options. Few strategies like bull call spread we do, ratio bull call spread, covered call, the one that I just explained. Likewise, when you are bearish, you sell stock futures, buy put options, or sell call options. You practice bear put, ratio bear put, covered put. So these are strategies that, generally on a very simple tone, many, very simple traders can also practice. So what is bull call or, put spread strategies? A bull call or a put spread is an options trading strategy when we have a view or limited upside or downside. Let's say if you do bull call or if you do bear put. Bull call you do if you know that Nifty today is 15,100, but I think Nifty cannot go beyond 15,250 now. So I have a limited upside, view, but maybe, downside can be more. So what you do, you practice bull call. In that, what you do, you buy Nifty at 15,000 call at 100 and you sell one OTM. You buy ATM or ITM and you sell OTM. So 15,000 would be my buying and my selling would be 15,300 here, like I've said. So my net risk would be 100 I have paid, 30 I am getting because I've sold. So my net investment instead of 100 goes down to 70. My max profit would be what? This is the difference. I'm planning, I have a difference of 300 points here from the strike. So 300 minus my investment, 70. My maximum profit could be 230. Why do we do this strategy? Because it brings down our investment, like we see here. If suppose I would only go for a naked call option at 100, it would be more expensive. If I can hedge it, because I have a limited upside, vision. So what I do, I sell one. So I get a 30 rupees premium with me. So my 100 rupees goes down to 70. So I gain 30% there. So this is how it helps. So this is how you practice bull calls when you have a limited, upside or downside view. So when you are moderately bullish or moderately bearish, you go for the spread strategies. Okay, somebody is asking me, can you share again the both slide in bull and bear market? Sir, I can share, but okay, I'll just do once quickly so that people can. Of course, this will be shared with you guys also. So these are bullish strategies, and these are bearish strategies. So we just covered in brief what is bull call or bear put. What we do, we just buy one ATM or ITM and we sell one OTM. This is how we do. So the next, what is ratio spreads? It is nothing, just one leg a more. In ratio spreads, what we do, we sorry, it involves buying a call or put option, that is ATM or OTM, and then selling two of the same option further OTM. Let's say if I'm buying 2 lots, 14,900 put. In this case, I've taken a put example, because last one I took a call example. This is a put example. Let's say I'm taking a at the money, or let's say for 14,900 put I've taken, and I have sold 15,100. I mean, I'm selling 14,900 OTM. These are OTM for me, and I'm buying 15,100. So you buy one at the money or in the money, and you sell 2 lots of that same contract for the OTMs. Why do we do that? Because let's say 14,900 put is trading at, for 40 rupees, let's say, and you have 15,100 at, let's say 60 rupees. So in 2 lots, what would you gain? 80, because you're selling 2 lots. So 40, 40, 80. And this 15,100 is 60. So net you would get to your account would be 20. So that is what you have to make sure that you protect that, because that is what would be your maximum profit in this case. So this is how it is practiced. Uh, for all these, let me just tell you, these are all very theory things that I'm telling you, because it needs a lot of practice. So if you are entering into any particular trade, please make sure that you do consult a financial advisor, take tips from them, and make sure you have the perfect understanding. But these theories will help you to know that what you should be doing. Let's say if you're bearish, but you think 100 points or 200 points max you're seeing, so you can always call your financial advisors and ask them to set you up for a put spreads, so that they would also understand that you have an idea. Nobody's going to take you for a ride. So that is how it should be helpful for you. So like we discussed one bullish strategy and we discussed one bearish strategy. So this is one for non-directional. It doesn't matter where market goes. But these are few. This is one of the strategy that Barkman practice, where you have limited loss and limited gains. No matter wherever market goes, your loss is limited also, your gains is also limited. The strategy name is Iron Condor. In this, what happens? You sell one OTM nearby. That is, let's say Nifty at 15,100. So what you do is that you sell 15,200 call and you sell one 15,000 put call. And then what you do, you buy one 15,300 option and you buy one 14,900 put option. We sell one OTM put and buy one OTM put, even the lower strike, and we sell one OTM call and buy one OTM call, the higher strike. Why? Because the higher the OTM, I mean the farther the OTM, the premium is less. So when you're selling the nearer OTMs, you are gaining that because you're selling, so you would get that into your account. So that is the profit that you get. Let's say 15,100 Nifty here. So 15,200 you would sell call and 15,000 put you would sell. So let's say 15,200 call is 70 rupees and 15,000 put is 70 rupees. Let's say 140 you get to your credit. You also have to buy because you're hedging. So you buy 15,300, let's say at 50 rupees. And likewise 14,900 you are buying at 40 rupees. So it is what 90 rupees you are buying. You are getting 140 rupees. So you have a credit of now 50 rupees with you because 90 would be an investment which you would pay it off from what you're getting 140. So it helps you. So this 50 rupees would be a max profit. Likewise, a loss would be also protected no matter where the market goes. It has a very strict payoff. So if anybody wants any interest in this sort of strategy, can always be in touch with your financial advisors. They will help you out with the payoff. They would give you exactly if the expiry happens at this strike, so what would be your maximum gain and what would be your maximum loss. So you are always aware, and it is hedge both sides. Market going up also will give you limited profit. Market going downside also would give you minimum profit and minimum gains. So it's a non-directional. It doesn't matter where the market goes. So these are few strategies that we discussed. This is again one strategies which involves only selling of options. Like I said, selling of options has its own merits also. If anybody is well versed with the market and they know how to do it and where to do it and when to do it, it helps a lot. So like I said, when VIX is very high, which is like now 23, 24, premiums are very high. And let's say in Feb series, when I entered the contract after having the rollover, analysis and everything, I knew that, maybe 15,500 would be my max upside of 15,700 for Nifty. And my max downside for Nifty would be 14,000. It cannot be below that. So what I would do in that thing is that, I can sell 14,000 put because that's my max downside. I'm expecting. I'm expecting 15,500 to 700 max upside. So 16,000 call. Whatever premium I get, I sell both, and that is what I have for me till my expiry, whether it's weekly, whether it's monthly, whatever expiry I choose. So, but people, there are many strategies to, they practice this rigorously. We also at PL do that. We do it on weekly, contracts. Mainly, we do it on every Friday, and it's a very disciplined strategy that we follow. Very limited gains, limited loss strategy that we follow, which we aim to give a return of yearly 24% to 30% max that we aim at. It's a very disciplined strategy. Yearly gains of 24% is what we aim at, and it is also practice to hedge against when you have a very passive portfolios. Passive as in, let's say somebody has 30,000, 50,000 shares of ITC. So, what would that person do? They just having in cash, they don't have in futures, and they're not doing anything with that. But what they can do is that every month on that passive portfolio where they're not active, they're not doing anything, they can earn 1% to 2%, let's say 3% also on that particular portfolio. Let's say ITC is trading at 230 now, 220 now. So I know ITC, if I know how, the way ITC moves in a month, I can know that it cannot move beyond 20 rupees or 30 rupees in a month. So what I'll do is that I can sell 250 call or 250 260 call and just wait for that premium to erode. It would be roughly 2-3% of what the portfolio is. So monthly your gain around 2% on an average is what one can earn when the selling options on this portfolios. This again is a very detailed thing. You have to talk to your financial advisor, and they would guide you nicely in how to do it. But it's also something that every now and then everybody practices to have some fixed gains overall. Okay, somebody is asking me to explain short strangle again. Of course, I will explain. Short strangle is nothing but selling of one call option and one put option. You sell two options here, one call and one put. And quite far OTMs. Like I said, Nifty trading at 15,000 today. 14,000 put I can sell and 16,000 call I can sell, because I think by Feb expiry, Nifty would be trading below, within this range, 14,000 to 16,000. It is not going to go above 16,000. It is not going to fall below 14,000. If that doesn't happen and it stays between 14,000 to 16,000, I would have my profits. So this is how short strangles are practiced. One has to understand when you're doing option trading. You see, the OTMs are quite attractive because they're very cheap, but they also have their own demerits. Like I've said, buying out of the money options because just they are cheap shouldn't be the key factor when you're doing option trading, because if the view is not proper and it is not decisive, it is not concrete, you would have an erosion, decay would be there, and you would gain nothing. And very trading illiquid options or low volume option strikes, also you have to understand which volume strikes are very, very active. You have to also participate that. So, and leaving short options to expire if you're not squaring off can give you very, very high risks, loss. So that is one thing also you have to understand when you're doing option trading. So these are PL derivatives on daily basis. What we do, we generate daily calls, we give in futures and options, both stocks, indices, This time frame is mostly intraday or max T plus 1 day. Rate of returns aimed at each call is anywhere between 1% to 2%. Risk reward is 2 is to 1. We do a mix of technical indicators and derivative indicators to come out with the cost, because I believe, when your derivative indicators and technical indicators, the basic ones, let's say the RSIs, the TMAs, or in MACD, if they all fall in same line, you have the most concrete view. You can hardly go wrong with your trade. So this is what we practice when we give our calls. Weekly calls also we give. Stock futures mainly, time frame of course weekly. Rate of return is 3% to 5% anywhere we aim at. We also do options, like I said, calls given in indices mainly. When it is an event based strategies, rate of return is anywhere between 8% to 10%. We follow many strategies: bull, bear, strangles, ratio, all that I've just covered with you. Expiry trades, we do one very particular product from my desk on expiry are the Hero Zero trades, which is very famous in PL. And Prabhudas Lilladher, and these works, this has a very high success ratio. I would share one also, one Hero Zero trade. Where Hero Zero trade is what you have very limited investment, and if it works, then it's a hero trade and you have massive profits, which we have done this month very nicely with two stocks, and I'm very proud of it. I'll show you also what we have done. So these are just the past 6-7 months, my desk performance, how it has been, number of calls generated, profit calls, loss calls, net, what we are gaining. So this is just performance. So like I was saying, my recent success, like I said, a Hero Zero trade. This is what I gave start of the series on 29 Jan. SBI 335 call. SBI was trading at 285 to 90 at that time. 335. I gave a OTM option. It was given at only 3 rupees and 50 paise. After the budget and after the result of SBI, it went up to 84. From 3 rupees to 84, you can imagine one lot is 3,000. So you can imagine 1 rupee gives you 3,000. So you can imagine the kind of profit, people gain. We've gained massive here. Recently also I gave MFSL 800 CE when MFSL was trading at, Max Financial was trading at 760, 770. At 10 rupees only. Within 2 days, it zoomed like anything. And now today it was trading at 45. So 10 rupees went up to 45. One lot is 1,300. So each rupee you are gaining 1,300. So SBI on an investment of roughly 10,000 to 11,000, it touched highs of 2.4 lakhs. And MFSL on an investment of only 13,000 rupees today only, anybody must be gaining more than let's say 80,000 or something. So these are how Hero Zero trades work with me. So this is the page. If anybody is interested, they can go and open an account with us, and we'll be there at the service to help you out with your investments and your daily trades. So we are open for this question and answer. So please do let us know. So we can start. Any questions, please do. Yes, questions, please. Either I have been explaining very nicely, or nobody has understood anything. So because there are no questions coming out. Okay, how to spot arbitration opportunity in FNO? So like I said, these are very detailed and critical things that you for your investment, if you're talking and if you want any support, you have to talk individually with your financial advisor. They would help you out. Should PCR be calculated for all the series combined or for individual series? So PCR for Nifty, as a whole, we get it. See, when Nifty overall PCR is 1.2, 1.32, like it is the same. Above 1.5, it is it is very good. Anywhere between 1.2 to 1.8, whenever you see the overall Nifty PCR, you should see that it is in the very bullish zone. Whenever it is above 1.8, you can understand it is approaching that overbought zone. So some profit booking will be seen and Nifty will slide. Likewise, when the Nifty PCR overall is 0.6, 0.7, that means that it is approaching the oversold zone and that some bounce back will happen. So you can buy. But individual strikes, like I said, it helps only when you are trading and you want to trade immediately with your if let's say I said you are just entering market, just randomly at any point of time, and you want to trade, so individual PCR would help to understand what you should be doing, buying or selling or wait. Index is where one should be starting for beginners so that you can practice. Like I said, PCR please follow for beginners for index trades. Sir, options trading strategies at PL, we have a basket for that, sir. So if you want, you can get in touch with us through email or anywhere. We would explain you what sort of portfolio you have or what sort of investment you're looking forward and what can be done with that investment. Generally, Mr. Nirali is asking, okay, somebody is asking, generally, do option sellers make more money than buyers? So it depends. It depends. If I was an option buyer in SBI, like my Hero Zero trade, I would be, gaining massive. And selling options, like I said, it generally definitely gives you good money, but you have to have more conviction. You need to know when to exit, what to do, your views, your calculations. It's risky. It's not for beginners. Okay. Any more questions? Do we need to know all the Greeks before beginning? No, not really. You really don't have to know all the Greeks. Like I said, if you're doing options, this time value, one thing one has to understand. But of course, the more you know, the more the better. There are many other things also in option trading one has to understand. Whatever I told today and the session covered was very brief, very superficial for people just to have a grasp of what is happening, or else options is a very deep study. Thank you, Nirali. And okay, if everything is settled and everybody is quite happy, I hope this session was useful and some learning was there. And if you are interested for us, so you know when to and how to approach us, please do get in touch with Prabhudas Lilladher. We'll be happy to help you out.